Hello, my friends. Welcome back to the channel. This is Jason, host of Fighting Words Financial. And first person on, let me know if you can hear me. I don't know if anyone's actually watching right now. I wanted to do one of the harder things about talking about investments today, and I wanted to talk to you about the minutes of the Federal Open Market Committee for the meeting that basically just ended here on May 3rd. Okay. And let's talk about the meetings for the last or the minutes for the last meeting. Let's talk about what they mean coming up here in the future. And let's talk about how those are going to be digested by the market as we go forward. Okay. So, so I want to pull up the minutes from last month's meeting, and I realize that is sort of out of date here. But I want to take a look at that because I want to show you what the primary concerns were walking into that. I'm going to add that to the stream kind of right here. So this is the minutes of the Federal Open Market Committee meeting, May 3rd to 4th, 2022. And this is just printed in PDF format, guys. And they start, and it's not exciting, not a ton of graphics here, but actually, Bob Johnson, thank you very much for letting me know that everything is loud and clear. Not sure how long I'm going to be on the meeting today. I wanted to cover some of this stuff. It really depends on the questions that I'm getting and the sort of response that I get from the audience. But yeah, so developments in the financial markets and open market operations. The median debt survey respondents also projected a 50 basis point increase to the target range at the following two meetings, and another 125 basis points increases by middle of next year, bringing the total projected midpoint of the target range to a peak of 3.13, which basically means they want it between 3 and 3.25% for those short-term loans, which makes sense. Historically, that's closer to the average, and it's going to do something about controlling inflation. So market participants continue to note significant uncertainty regarding economic outlook and the degree of policy tightening ahead. I think today's meetings have kind of made that clear, meaning it's actually a little bit more pessimistic from the last meeting. Instead of looking at a quarter point per quarter, we're looking at 50 basis points now for the next 2 quarters and probably a quarter point per quarter after that. But what we're seeing is solid commitment to slay the inflation dragon here. And what they went over for last month was the outlook for runoff of Federal Reserve security holdings. And they were pretty explicit about how much they wanted to get rid of here. So we're looking at, after 3 months or so, $60 billion per month in Treasury securities are going to be allowed to run off the balance sheet, and $35 billion per month for agency mortgage-backed securities are going to be allowed to run off the books. You're taking $95 billion a month out of the economy. You're looking at basically 1.14 trillion. I'm not doing the math in my head correctly. $1.14 trillion over the next year or so coming out of the economy, right? So that's what we have to look forward here. So longer private, borrowing rates moved higher. 30-year fixed mortgage rates are above 5%, the highest levels in a decade, and the equity indexes were significantly lower. So one of the things that you will note on every single page here that I'm circling, and this is a 12-page report, on every single page here, they mention continuing lockdowns in China with the zero COVID policies and how that's going to affect price, or how that's going to affect supply chain. One of the other things that they constantly reviewed here was the fact that U.S. currency is strengthening against foreign currencies, up 9% against the Bank of Japan. The yen depreciated 9% against the dollar. It's its weakest level in over 2 decades. And basically, the effect of zero COVID policies and widespread lockdowns, the renminbi depreciated against the dollar about 4% in an intermediate period. This is actually not necessarily great for the U.S. economy. That makes our exports to those countries is substantially more expensive, and their imports quite a bit cheaper. And it may exacerbate some supply issues if those imports are artificially cheap, which I don't think they are at this point because of all the issues we're having with supply. So next, there was the development in money markets. The effective federal funds rate rose 25 basis points following the increase in March. Overnight rates also rose. They were very steady. This is very important, though, and this is a subject that hasn't been covered in a number of years, at least not since 2008. but the overnight reverse repurchase agreement usage that rose. So the overnight reverse repurchase agreement facility is something that was set up by the Federal Reserve a long time ago. I don't actually remember if it's still run by the Federal Reserve, but it's there to provide a floor for rates when it comes to like overnight lending for dealers in securities. And it's a sign that they were a little bit nervous at that time that rates were going to fluctuate kind of severely. That hasn't really happened. It's gone pretty much according to plan. So, so information available at the time of the May 3rd, 4th meeting. Remember, this is from last month. Was that real gross domestic product declined in the first quarter. However, first quarter and private domestic final demand was faster than in the previous quarter, meaning that that private domestic final demand was still pretty high, and labor conditions tightened in March. The consumer price inflation through March was measured by the 12-month percentage change in the price index for personal consumption expenditures. That is the PCE. All right. So one of the problems with scientific reporting and one of the problems with economic reporting is a lot of times when you are looking at what's going on with that reporting and you're reading a newspaper article on it, or you're looking at, I know people say, oh, the PCI is not entirely reflective or even a good reflection of what inflation actually looks like. So, folks, this is actually not the only thing that the Federal Reserve is looking at. They're looking at this, which is that personal consumption expenditures index, which includes in there food, transportation, energy costs, all that stuff, your housing costs. And this is the composition of the index that they're looking at here. So this is, the CPI is one way of measuring inflation. The PCE is another way of measuring inflation. They're definitely looking at both of these things. Okay. So let me see how the Fed meetings are the meeting minutes, the current ones out. I kind of wanted to review what we went over last time. Let me see here. Okay. So in the news today, which paradoxically saw the market rise. And actually, I didn't even check the market as it closed. Let's check that first. So the NASDAQ is up 1.51%. The Dow Jones is up 0.6%, 192 points. Pretty much every stock that I looked at over the last day or so is up, and everything in my portfolio is up. So this is kind of what they're looking at here. The Federal Reserve sees aggressive rate hikes providing flexibility later on this year. Once again, this is an interpretation of Craig Torres. I need to go back and read the actual meetings, the meeting minutes once that PDF comes out to let you know what my own opinion was. So, so this article says that most participants judged that a 50 basis point increase in the target range would likely be appropriate at the next couple of meetings. That was the next two meetings. And that's the minutes of the Fed's May 3rd and 4th meetings released on Wednesday. So this is the meetings minutes that were released on Wednesday, but it was the meeting from March 3rd to March 4th, right? Okay. So this is basically the best view of what we have in the market and the Federal Reserve's actual opinion, right? So consumer prices continue to rise rapidly. Total PCE inflation was 6.6%, which is lower than PCI inflation or CPI inflation, right? And that takes a look at the proportion of how we spend income as well. And core PCE inflation, which excludes changes in consumer energy prices and many consumer food prices, was 5.2% over the same period. The trimmed mean measure of the 12-month PCE inflation constructed by the Federal Reserve Bank of Dallas was 3.7% in March, 2 percentage points higher than its year earlier rate of increase. A new version of the staff's common inflation expectations index, which combines information from many indicators of inflation, such as expectations, inflation compensation, all moved up in the first quarter and was at the upper end of ranges of values seen since 2005. 2005 is where we really saw the kind of the stock market take off after the dot-com bust. Basically, 2000, 2001, 2002, the market was down 9, 11, 22%, and it was basically flat. After 2005, we saw value kind of take off in that time period, and that's when we saw a significant amount of increase in prices as well. So both real PCE and residential investment increased in the first quarter at rates similar to those seen in the fourth quarter of 2021. Business fixed income growth picked up sharply in the first quarter, with spending on equipment and intellectual property products posting a large increase. inventory investment moved lower after surging in the fourth quarter of 2021. And we're still seeing that reflected. If we remember, Target reported that inventories were up 42% year over year. Walmart reported that inventories are up 32% year over year. Probably that's a lot of that has to do with just misjudging what was going to be needed in the economy. So, yeah. Bob Johnson says, since the market is forward looking, has your bottom prediction for the stock market changed? No, my bottom prediction is still within 15% of 3,600, which is actually a fairly wide prediction, and it's not all that useful in terms of a prediction. Okay, so that's basically 3,600 to 3,000 is my absolute bottom. I think that right around 3,600 is where the market is fairly valued, where the S&P is fairly valued for the top of this economic cycle, and that we see a recession at some point. So, if you look at these meetings from these meeting minutes from this last meeting, the Federal Reserve is actually fairly happy with their response so far, and they recognize that they're going to need a little bit more of a response going forward in order to establish commitment to slaying the inflation dragon here. So they're not alarmed at all when I'm looking at this. The two things that they quote on every single page here, though, are the war in Ukraine contributing to commodity inflation, and continued lockdowns in China contributing to increased problems with the supply chain. So, and they talk a lot about borrowing. This is not something I don't talk about fixed income a lot on my channel. I talk a lot about stocks that I really like, but the liquidity in markets and the health of the fixed income markets is very, very important. And if you don't understand what's going on there, then you probably don't really understand what's going on in your stock portfolio as well. And this is something that I wanted to talk about here because there are some really encouraging signs when it comes to what's going on. So over the borrowing costs for residential mortgage loans increased substantially. We all know that, with the 30-year mortgage rate offer rates reaching levels not seen since 2010. The increase largely reflected the rise of the 10-year treasury yield, and corporate bond yields also increased, although the effect of the increase in treasury yields was partially offset by narrower spreads, right? Meaning there wasn't as much money to be made off of those trades. So municipal bond yields also increased notably. So bank loan rates for commercial borrowers increased, and rates on large syndicated loans were roughly in line with pre-pandemic levels. In consumer credit markets, rates on auto loans and new credit card offers continued to trend upward. Credit, which remained widely available for most types of borrowers, was broadly in line with pre-pandemic levels. Gross non-financial corporate bond issuance rebounded sharply in March. That's very interesting, meaning that a lot of companies out there were putting out bond issues, mostly reflecting an increase in investment grade issuance, meaning these are companies that are in really good financial condition. This is not like junk bonds or anything. While gross institutional leverage loan issuance slowed amid elevated geopolitical uncertainty. So this is where you get into the really interesting part here for these next two paragraphs. Commercial and industrial loans and commercial real estate loans on bank balance sheets grew robustly in March. Respondents in the April Senior Loan Officer Opinion Survey on bank lending practices reported a continued easing of lending terms, which is very interesting. They're making, because the price of borrowing money has increased quite a bit, they're actually lowering lending requirements. So I don't know what goes into easing lending terms in this respect. I would like more research on that. And they say there's strengthening demand for C&I loans, as well as easing standards for multifamily CRE loans, which means that companies out there building apartment buildings and condos and things like that, where we are in a housing crisis here. We don't have enough inventory to go around. It's still easy to get multifamily unit loans. Okay. For most small businesses, credit appeared to be available, although these businesses' demands for credit reportedly remained weak, meaning there's credit available, but the small businesses didn't really need it. Okay. So in April, the SLOOS large banks reported unchanged standards on C&I loans to small firms, while small banks tightened standards modestly to such firms. In consumer credit markets, credit balances grew strongly in the first quarter amid easing standards and greater utilization, and auto credit outstanding continued to grow steadily through February despite vehicle production shortfalls and low vehicle inventories. Residential mortgage credit conditions remained accommodative through March, despite the increase in mortgage interest rates, particularly for strong borrowers who met standard criteria. So that's all really good, healthy news about credit markets. And that's nothing to sneer at. That is nothing to be unhappy at. And these are things like you're not necessarily going to get this in a 2.5 minute, or 35-second soundbite that you're getting on financial news. That's just not the way it works, right? And I think it's worth it to go through the FOMC meeting minutes on your own to digest this. A lot of times you have to read the tea leaves a little bit here. A lot of times they don't say directly what their largest concerns are, but their largest concerns, if I had to look at what is mentioned most frequently here and what they feel like the most frequent contributors to inflation are, it's going to be supply chain disruption because of China, because of their zero COVID policy, because of how they've chosen to handle this, and Russia's invasion of Ukraine. And they mentioned it again on this page. The staff provided an update on its assessment of the stability of the financial system. The staff judged that amid substantial upward shift in interest rates, Russia's invasion of Ukraine, and ongoing disruptions to supply chains, the financial system outside of commodity markets had been resilient. However, larger or prolonged disruptions in commodity markets could interfere with other markets and real activity more broadly. To date, however, such potential spillover has been limited. The staff noted that increased uncertainty and ongoing volatility had reduced risk appetite in financial markets and eased pricing pressures, although valuations of many assets remain elevated. So CRE valuations appear to be somewhat elevated, except for sectors that were affected most by the pandemic. So residential housing prices have risen rapidly. I fully expect those to start coming down here pretty soon. So let me see here. Do you feel that large cap blue chip tech will be on the hook to hit those lower 500 S&P 500 index ranges or other companies? I think it's going to be a contribution across the board. Where the Federal Reserve, just by balance sheet runoff alone, is going to suck $1 trillion out of the economy this year. I'm hoping that we are near a bottom right now. Like I said, in the perfect world where we don't necessarily go, like I'm assuming right now that we are already in recession, meaning that we had I'm assuming that we had negative GDP growth in the first quarter. We have flat or slightly negative GDP growth in the second quarter, negative GDP growth in the third quarter, possibly positive GDP growth, anemic, GDP growth in the fourth quarter. But the market's going to recover far sooner than that. Let me see here. Protop Ram says the market will not go lower. I do say that 38 could possibly end up being the bottom. I say that 36 is probably closer to it. That's just based on math. The market doesn't always follow the math, right? If it did, then things like technical analysis would always work, right? It doesn't. So I think your assessment that 38 could be the lowest, Protop Ram, your assessment that 38 could be the lowest is entirely possible. That hasn't stopped me from dollar cost averaging my way into things. But one of the things I've stopped doing right now is I've stopped selling covered calls anywhere close to the money right now. If I'm selling covered calls, at any expiration longer than 30 to 45 days, I'm so far out in terms of, I'm 40, 50% above, above current prices, because I still want to participate when the market turns around, because that turnaround is probably going to be pretty violent, right? And when that happens, I want to participate. I don't want those shares to get called away. So I'm sacrificing what I can earn. I'm earning a lot less right now in premiums on the calls that I'm selling, because I think that the market's going to turn around fairly violently. But I'm reinvesting the premiums and I'm actually adding a little bit into my account. So yeah. In Pro Top Rom, you think we hit bottom right now? You wish I had more money to invest? I think a lot of people do. I think this is a giant misallocation of wealth. And I'm all for that sentiment. So keep reading through this. And once again, on this page, Ukraine, Russia, China, and COVID mentioned again. So at this point, I think there was this researcher in Korea that put out an article that was once again widely misinterpreted by the press. Like I said, science and economics are misinterpreted by the people that report on it. But the headline was hilarious. He said it was a Korean scientist who basically said that if you haven't caught COVID by now, you don't have any friends, right? It's because you've not had enough social interaction over the past 3 years to be exposed to the disease and catch it at this point. China's zero COVID policy may have actually caused this to last a lot longer, but then I understand the choice they had to make. They simply didn't have the medical capacity to treat the number of people. We didn't have the medical capacity to treat the number of people that we had. It could have been a lot worse in China. And I think that I'm not a doctor, but I think that these far less intensive variants that are coming out are acting sort of like an inoculation for the population now, instead of getting some of the original strains, right? Which may end up being less disruptive to their society, not just their economy. Jepson, Belgium beer is here. Let me see. If you are the only question you ask a Belgian is Jupiler or Stella. And I'll be honest, I'm a Jupiler fan, and I'm really shocked that is not the beer that was chosen to be exported to the United States rather than Stella. So yeah. Anyway, back to the meetings here. Let's talk about consumer demand here and what they noticed. So in the discussion of the household sector, participants indicated that they expected robust growth in consumption spending. They pointed to several elements that supported this outlook, including strong household balance sheets, which household balance sheets really have never looked better than they are now, wide availability of jobs, and the U.S. economy's resilience in the face of new waves of the virus, meaning that we've just chosen to ignore it, basically. The considerable increase in treasury yields across maturities over the intermeeting period was associated with rising interest rates faced by households, particularly on home mortgages. A couple of participants reported, these are survey participants, that their business contracts continued to see robust housing demand and elevated home prices despite the higher mortgage interest rates. I don't expect higher home prices to persist for this much longer. At some point, inventory comes back onto the market. Inventory could come back onto the market right now because variable people, we've seen a little bit of an uptick right now in variable interest loans. And if interest rates continue to rise, some folks are not going to be able to make those balloon payments, and they're going to elect to sell that home, put it on the market, and try and bail out. We'll probably see an increase. It won't be a huge increase because of that, but we're probably going to see a natural increase especially if we keep seeing full employment as people keep finding better jobs. Maybe they relocate. So with respect to the business sector, participants cited, we see here, healthy household balance sheets, inventory rebuilding as factors supportive of business activity and investment. So inventory rebuilding is pretty healthy here. The ability of firms to meet demand continued to be limited by labor shortages and supply chain bottlenecks, not by demand, which I think is the most important thing to understand here. There is still robust demand for everything. Great. So Jepson, so you saw the survey that I put out on my community screen, my community page earlier, where I asked whether or not you guys thought that NVIDIA would meet numbers, would exceed them, or would disappoint. My opinion is that they would largely meet numbers, which is actually really good in this era. But I read an article earlier today that said that data centers would become more and more center stage for NVIDIA. And I think that by next quarter, we're probably going to see earnings beats again, and that's going to be led by data centers. So yeah, let me see here. Oh, so Jepson is a Jupiler fan as well. Excellent. You have good taste, sir. Any thoughts on Airbnb exiting China due to the inability to compete with super apps? So I'm not sure that it's the inability to compete with super apps. I think a lot of it also has to do with the uncertainty because of COVID lockdowns. There's virtually no tourism going into China from from the United States and Western countries right now, and those are the people that would have been users of Airbnb, right? So a lot of people here that use Airbnb and a number of other services, they book through a couple of different services. And Airbnb traveling, I'm probably traveling somewhere out of the country here pretty soon. I'll use Airbnb to book there, and they have their own apps. And wherever I'm going, if I go to Brazil, I'm sure they have their own app there. If I go to Peru, I'm sure they have an app there that does that. Or if I go to China, I'm sure they have an app there that does that. But me, as a consumer that's used to using Airbnb, I would have used, Airbnb. The issue with China has really just been it's just been the unending lockdowns and how that's created uncertainty. So at least that's the impression that I got. There may be another case there. So I don't know. And it may have been that Airbnb's intention going into the China market was to capture Chinese consumers, but most other apps that have entered China like that have not really been all that successful. And I think that I think I remember reading an article on this a long time ago, that their intention was really to capture Western visitors going to China, and have them. Yeah. So I don't know. That is my opinion right now. It's rather scattered on this. And so back to this. And again, Ukraine, COVID related lockdowns in China, COVID related lockdowns in China. They mention at least 16 times in a 12-page document that these are their biggest concerns. And the participants in this survey emphasize that persistently high inflation, heightened by the risk of long-term inflation expectations, could become unanchored. And in that case, the task of returning inflation to 2% would be more difficult. And various participants noted downside risks of that outlook include high risks associated with the Russian invasion and COVID-related lockdowns in China. So the COVID-related lockdowns in China have to end at some point. The war in Ukraine may not end at some point. We get a lot of propaganda here in the U.S. We're one of the most thoroughly indoctrinated populations in the entire world, and you may not see it as propaganda, but we get a lot of propaganda. The Russians have momentum right now. I don't know how long they can continue that momentum. Somebody was making a big deal today about Russians pulling T-62 tanks out of storage and throwing those into the fight, saying this is an indication they're almost at the bottom of the barrel. You really have to study sort of the Russian way of war to understand that they still believe that quantity is a quality by itself, and the fact that the most effective weapon in this war has not been tanks against tanks. It's been anti-tank platforms against the tank. And so the addition of these T-62 tanks into the war, they may have the same net effect as the T-80s, T-72s, T-64s, all of those things. They're just a mobile artillery platform. And I think that that's kind of the point that's really being missed by people that are looking at this. We're looking at Russia having an enormous capacity to continue this war for quite some time, until they essentially run out of money, and until we get the world to cooperate in making them run out of money, they could continue this war. And it's going to have a continued effect on energy prices going forward. The thing that I find really, really encouraging here is Europe's response to gas. Right, we have a number of countries who've just said screw it, we're going off gas. We're seeing frantic building right now of liquid natural gas infrastructure. It looks like the United States is going to be exporting huge amounts of liquid natural gas. United Arab Emirates, huge amounts of liquid natural gas. Looks like the gas fields that were slowly being developed off the coast of Israel and Cyprus are going to see massive amounts of dollars go into those. And yeah, I do think that we are seeing a massive shift in the gas market. And natural gas, as a result of this, the market may actually become more globalized. It's been very, very local, right? People get confused all the time when it comes to oil, natural gas, and gasoline. Oil is a global market. Natural gas is not. Gasoline is not a global market either, right? You're always going to see wide differences. Like you could go to Saudi Arabia today and a gallon of gas the last time I was there, and it's been a while, but the last time I was there, gasoline here was like $3 a gallon, and it was like $1 a gallon there, right? About today, I bet it would be close to $2 per gallon. Somebody in Saudi Arabia, I usually have at least one person watching me here from Saudi Arabia. They could probably tell me it's probably around $2 a gallon, maybe $1.80 a gallon, and for very good reasons, right? So the United States produces about 9 million barrels of oil per day, right? Pretty close to the maximum we've ever produced. We use more than that. But that's not, and we use a lot more gasoline than that too. And so we have a market where we have to import gas from we have to import oil from other countries. We find it here, and there's always pressure on that demand. Well, you go to Saudi Arabia where they produce 9 million barrels per day. They don't use anywhere near that in terms of gasoline. And so most of the oil gets exported. There's a lot lower demand for it, and the price is a lot lower. Every oil producing country is like this, either through, not countries like Norway, right? Norway's kind of in the same position, like per capita wise, they produce a fair amount of oil, but because of taxation and because of refining there, you see oil prices or gasoline prices really high in Norway as well. And they're kind of like the Saudi Arabia of Europe, or you could consider Russia or Norway is basically the Saudi Arabia of Europe in terms of oil production. So those markets, like I said, not all petroleum markets are global. It's really just crude oil that's a global market, and everything else is far more localized, right? And that's what's really poorly understood by the public when they talk about gas prices here, gas prices there. It's affected by policy. It's affected by geography. It's affected by just production constraints. There's all kinds of things. So let me see here. Will Conterra stock counter my gas bill? Maybe not. I don't know. That's there's a couple of times in history where the price of something went up. I'm like, oh, well, my ownership in that stock will go up to compensate for, but it's all about cash flow, man. It's remember, it's unrealized cash flow if you just own the stock. You have to sell it to actually realize the money. And then in the meantime, money's still going out of your pocket. And having lived in Belgium myself many years ago, I would bet that the price of fuel in Belgium has to be close to $2 or €2 per liter right now. It would have to be close to €2 per liter, which would be roughly $8 to $9 per gallon here in the US. And so very interesting things going on. Mentioned, like I said, at least 16 times that I've counted so far, possibly more, right? The big news in these meetings is that they don't expect inflation to really be tamed until 2024, right? So they expect this, the CPE index to go from about 4% to roughly 2.5% to back down to 2 by 2024. So we should see pretty much a sharp curtailing of inflation by year end. It should remain slightly elevated through all of 2023 and back to the 2% target by 2024. Now, the Federal Reserve is hoping to do this, of course, without triggering a recession. I'm of the opinion that we're probably already in a recession. It's going to be a mild one. And I think that the Fed trying to do this, and I realize that somebody famous just came out and said there's zero chance of a recession. Okay, there's a chance of recession. I think that basically the Federal Reserve has strung dental floss across Niagara Falls, and they're trying to walk across it. And that's how difficult I think it is for them to thread this needle here of raising interest rates without causing a recession. The problem is full employment. In order to reduce inflation here, I think that they're going to have to reduce employment. And I've seen a couple of different articles here saying that the unemployment rate would need to go up to 7.7% in order to tame inflation the way they want to. But when you read through the minutes here, you realize the plan is quite a bit more complex. They have far more tools than these other people that in this article that I was reading had included in their plan. So you look at So the Federal Reserve is far more confident about this than I thought they would be when you actually read what they themselves are saying to each other, what's released to the public. And remember, some of this is reading tea leaves, right? So it looks like the balance sheet runoff is on track. Yeah, and they kind of go over what they're going to do here, consistent with the principles for reducing the size of the Federal Reserve's balance sheet. Remember, there's like $9 trillion is what is on the Federal Reserve's balance sheet. About $30 trillion overall in debt. The Federal Reserve has about $9 trillion, meaning that the United States public owns about $9 trillion of debt, or $10 trillion of debt. The Federal Reserve owns 9 or 10 trillion of debt. So basically, 2/3 of the debt we owe to ourselves, either to the Federal Reserve or to institutions and individuals here in the United States. And about 9 trillion of that is held by foreigners, usually by foreign sovereign wealth funds or central banks, right? The committee intends to reduce the Federal Reserve securities holdings over time in a predictable manner, primarily by adjusting the amounts reinvested of principal payments received from securities held in these system open market account, right? Beginning on June 1st, principal payments from securities held in SOMA will be reinvested to the extent that they exceed monthly caps, right? For Treasury securities, the cap will initially be set at $30 billion per month, and after 3 months, it will increase to $60 billion per month. So by the end of summer, they're going to be they're basically going to be allowing $60 billion in securities per month to run off the balance sheet. The decline in the holdings of U.S. Treasuries under this monthly cap will include Treasury coupon securities, and to the extent that the coupon maturities are less than the monthly cap Treasury bills. Interestingly, also, the issuance of Treasury bills has declined markedly over the last couple of months, which is one of the things that's kept prices kind of secure and are kind of stable on that too. Over time, the committee, this is interesting too, for agency debt and agency mortgage-backed securities. These are things like the Federal Farm Bureau, Fannie Mae, Freddie Mac. And there's a number of other like lending bureaus that you may or may not have heard of. And in order to backstop those, they were quasi government before 2008, and then after 2008, they are definitely explicitly backed by the government when the government started buying their securities. They want those to run off, and they want them to function in a healthier way, and they have not done so in more than a decade, right? So that will initially be set at $17.5 billion and will increase to $35 billion per month. So they got $9 to $10 billion on their balance sheet. They're going to be eliminating about $1 billion per year. I would be in a lot of ways, I'd be happier with them modestly increasing interest rates and severely decreasing the amount that they have on the balance sheet. I don't think that the Federal Reserve should be in this business of owning so much of U.S. debt. So over time, the committee intends to maintain securities holdings and amounts needed to implement monetary policy efficiently and effectively in its ample reserves regime. So to ensure a smooth transition, the committee intends to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level where it judges to be consistent with ample reserves. Once the balance sheet runoff has ceased, reserve balances will likely to continue to decline for a time, reflecting growth in other Federal Reserve liabilities until the committee judges that the reserve balances are at an ample level. They don't tell us what that is. What is that ample level? Okay, so undertake open market to maintain the federal funds rate in the target range of 0.75% to 1%. All right. Conduct overnight repurchase agreement operations with a minimum bid rate of 1% and an aggregate operational limit of $500 billion. Okay, that's just stuff describing those overnight loans to help keep rates consistent. So, all right, so that is about all. Okay, so yeah, that's more about that. So that's about all I'm going to cover with the Federal Reserve here. Happy to, and that the Federal Reserve minutes that were released. These minutes can move markets, guys. And basically, there's not a ton of bad news here. And it's kind of counterintuitive. You'd think that the Federal Reserve's going from, hey, we're going to raise interest rates a quarter point per quarter to like, no, we're going to do it twice at 0.5% and kind of front load some of what we're doing. You'd think that the market would react seriously negatively to that. But the reality is a lot of times markets just want, they want to know that the Federal Reserve is serious about inflation. They want to know that they're really, really trying to kill it here. And I think they just sent a really clear message. This is a shot across the bow. Pat Mulligan says, A liter of petrol in Ireland is about 1.95 euros, that's pretty close to $8 a gallon. So, what is this? U.S. got to send some Reaper and Predator drones to Ukraine. Kamikaze drones to be very effective, though. Yeah, yeah. I don't. I try to be neutral on here, but let's be honest here. I am definitely not in favor of a Russian invasion of Ukraine. Ukraine is a sovereign country. However, me getting too overly critical of them would be kind of hypocritical on my part as an American. I do say that I'm definitely on Ukraine's side, though. Okay, but also remember that I'm quite a bit older than you guys. I was raised in an environment that made me biased against Russians, right? And so, in the effort to be fair over this, I'm gonna not comment too much on this subject. Okay, so Eric M says here in Vancouver we're paying 8.50 Canadian a gallon, or 2.3 Canadian a liter, and Canada has the third biggest oil reserves in the world. Yeah, so like I said, gasoline markets are local, very much local. I remember when I traveled to Brazil a really, really long time ago. I don't remember exactly how long this was. I think it was before Bush, because I didn't need a visa back then. And I remember it was gasoline that was severely cut with ethanol at the time, but it was dirt cheap. It was like $1 per gallon or something. It was actually dirt cheap. And Jepson says war is never good. War has ceased to be good for business because of the way the business environment has changed. Unequivocally, war was good for business owners or owners of the means of production in previous times. Today, our economies are too globalized. War is just simply not good for anybody. And it's something that I want us to do without. It's extremely disruptive to my personal economic projections. I don't like it. That's very selfish. I realize that, but I think the whole world needs to realize that nobody benefits from this. Nobody does. Okay, so I have extra time today. I'm kind of done with what I wanted to present. If you guys have questions, ask questions. No such thing as a bad question here. If I can't answer it, I will. If I cannot answer it, then I'll just say I can't answer it. But let me take a look at some top headlines here, and let's see if there's something we want to talk about on Yahoo Finance, on Barron's. And Barron's, what I'm showing you guys is actually behind a paywall. It's behind a paywall. And this is something that my Patreon members pay for. I use my Patreon dues to pay for my Barron's access and access to a couple of other things here. Barron's doesn't get too upset when I show this over a live stream, but a couple of other companies get upset. So, so Fed sees half point rate hikes at the next couple of meetings, and it goes over why that's okay. All right. Bernanke on inflation and employment hasn't behaved like this in 70 years. So I read this article earlier, and it's comparing inflation and unemployment to post-World War II and post-Korea, which I think is a more accurate assessment than trying to compare it to the 1970s. I'm already hearing people talk about stagflation this and stagflation that. Man, it is way too early to have the discussion about stagflation. We wouldn't know what's going on for quite some time here. So, yeah. All right. So let's talk about any of the headlines that you want to talk about. And SEC to tighten rules, funds labeling themselves ESG. Very interesting. All right. Do we want to talk about Elon Musk news? I'm a little tired of talking about Elon Musk. A little bit tired. So let me see here. Exxon and Chevron feel a mood shift going into annual meetings. I am sure that they do. Let's take a look at this real fast. What is the mood shift that Exxon and Chevron feel, other than the fact that they're going to be making money hand over fist for the next 10 years until EVs kind of displace a lot of oil usage? So big oil shareholders have a new outlook, and it's not just because stocks are up. A year ago, investors forced oil companies to change policies or directors with votes in annual meetings. This year, the atmosphere has changed. Companies face less pressure to change their direction, and climate proposals in particular have been faring worse than in the past. Sorry, guys, I'm getting a call. Yeah. So the world has changed too. Russia's invasion of Ukraine, which has rocked energy markets, has caused investors and policymakers to see energy as a national security issue. As Europe races to replace Russian oil and gas with other sources, government officials have been asking producers to drill for more oil instead of cutting back, because they were definitely coming back. The ESG movement, it's a megatrend and it's going to continue, said Chevron's CFO Pierre Briber in an interview last month with Barron's. But like anything, there's ebbs and flows to it. And I think there's been a bit of a recalibration that predated the Ukraine conflict. So, yeah, I'm not going to read the entire article here, but this just discusses the changing environment here with oil that I think we all know what's going on. So, let me see here. I got Pat Mulligan here. Says, is it showing up for you guys? Honest observation here. I can't understand how your YouTube channel does not have more subs. I follow Bazinga all the time and your content is just as good. Well, thank you so much. I don't know. I stutter a lot more than Bazinga does, or I don't know what's going on. I do know that whenever I do a live stream, I tend to lose subscribers. That's not necessarily why I do the live streams though. But yeah, I'm sorry. Somebody made a something that I wanted to talk about. As somebody made a comment, I'm going to get to that in just a second. But thank you for the compliment, Pat. Part of it is I'm inconsistent. Like I haven't been 100% consistent about putting out videos. I got my subscribers originally from the videos that I put out. Now I'm finding live streams easier to do to a degree. And yeah, so, but thank you for your comments. Protop Rom says many fusion reactors under ever electric charging station. Is this possible? Tesla implement something like that? So the technology for fusion reactors is likely going to come from an academic source, and it's not going to come from a commercial source. The funding has all been in academia for this, and that's one of the things that I think. So I've been actually following fusion for a long time. So there are these mini fission reactors that I just heard someone talk about recently. And I think that's actually, I want to say it's a sodium reactor or sodium cooled reactor. I don't know. I read the article on it and I thought that was very interesting. And for a number of different reasons, for safety reasons. But fusion is still a ways off, Protop Rom. Whenever I hear someone talk about fusion and somebody brings it up in my life at least every 3 to 6 months, I just kind of sigh because I've literally been a fan of fusion since I was like 8 years old. And I remember reading an article in like Time magazine or something like that about the research that MIT was doing and the fact that the Russians were ahead of us in fusion technology. They were using, electromagnetic containment to do this. And so there is a project going on right now at MIT, and there's another one going on somewhere where they're finally actually trying to spin up a large enough fusion reaction to where, and it looks like it's going to take 8 to 10 years to build up the necessary heat to do this. But at that point, we're going to know whether or not it's possible to have, an actual fusion reactor, a controlled reaction. So yeah, I'm actually kind of positive about that, but cautiously optimistic just because I've been waiting for this now for 40 years, because I'm almost 48 now. I've been waiting for it for almost 40 years. So yeah. So JP Morgan predicts double-digit gains for Bitcoin. The European Central Bank sees nothing but risks. Dow books a fourth day of gains. Stocks rally after the Fed minutes signals flexibility on interest rate hikes. Apple can't keep up with the market. iPhone doubts and interesting. I'm not sure that I have iPhone doubts. I do think though that here's kind of the issue. You looked at Snap's earnings yesterday, and we talked about how Snap's earnings were really related to changes in Apple's privacy policy and the lack of the ability to really target ads towards, really target ads towards their users, and how globally Apple is only about 14% of market share. Somebody said on a live stream yesterday that Apple has about 50% of market share in the US. So I kind of just did an assessment of the people that I was around yesterday, and that would appear to be the case, but I'm not sure. But it's because I'm a little bit higher up on the income scale here. I don't know. I don't use Apple products. I use largely because I worked for the government at one point, and for the longest time you could not use Apple products. So I just got used to using Android, and I got used to their security features, and that's what I'm comfortable with. I'm not part of the Apple cult or the Android cult. I just use Android for its security features, right? Yeah. So actually, here, this is a good article here. 4:07 Eastern Standard Time. Inflation will take years to hit the Fed's target, the CB, and that's what I was talking about. So the Fed's budget deficit will contract by $1 trillion, or the federal budget deficit will contract by $1 trillion in 2022. Plus, we have $1 trillion running off the balance sheet by the end of the year. While inflation will take till the end of 2024, that's what we talked about, right? The CPE, right? The take being at about 4.5% this year, about 2.5% next year, and dropping back to 2% by 24. And that's the Federal Reserve's target level of 2%, according to new projections by the Congressional Budget Office. So the deficit will drop $1 trillion from $2.8 trillion in 2021. The decline was led by a reduction in pandemic spending. This year's budget deficit represents 3.9% of gross domestic product, decreasing from 12.4% last year. That's going to go a long, long way towards taming inflation. You're taking 8% of the spending out of the economy by the government right there. This nonpartisan agency estimates that by the end of the year, this will rise to 6.1% of GDP in 2032 under current laws, and higher than the 3.5% of GDP that deficits averaged over the last 50 years. So this year's budget represents a slightly higher than average deficit over the last 50 years, a vast decrease from last year. So this is really encouraging. And baseline deficits are going to average about $1.7 trillion annually from 2023 to 2032, a figure that remains large by historical standards. So yeah, that's still, we're not out of the woods. We still have issues, but yeah. Hold a second. Bitcoin will never be adopted. Wall Street cannot control it. They are not interested. They may not have a choice, and Bitcoin may end up being something other than money, right? It's a transfer of value. Money operates as a transfer of value, but something else out there operates as a traditional transfer of value that's over 1,000 years old. And I'm talking about the Hawala system that's used in North Africa, the Middle East, and Southeastern Asia to transfer value between parties. It's entirely based on trust, and it's done irrespective of the currencies that are issued, and that's existed for a very, very long time. So a long time ago, when I studied terrorist financing professionally, this is one of the things that we investigated, and we found out that it was impossible to stop this without going full 1984 and listening in and data mining every single conversation on the planet, which we're probably doing right now with some of the new AI tools that are out there. You can't really stop the Hawala system, and particularly when a lot of this is delivered in coded form, which Bitcoin at some point everything's going to be delivered in coded form as well, and we're going to have transparency. We don't have anonymity with this now, but at some point, I think we will have anonymity, but transparency with everything on blockchain. I think it will be adopted as a transfer of value. There is zero way you could stop it without shutting down the internet. And there is zero way that you can censor it or control it on a mass basis without shutting down the internet. And it's just going to get harder and harder to shut down. So I don't necessarily know if it's Bitcoin that wins in terms of blockchain technologies, or Ethereum, or someone else we haven't even heard of, but it's here to stay. It's going to replace the Hawala system at some point. And yeah, there we're going. So that is not just my opinion. Maybe linking Bitcoin to the Hawala system is unique. I mean, I'm the only one who's talking about it that way. I don't know if anyone else is. So have you done any more research on Jumia? Any thoughts? My research on Jumia has really been pretty shallow, meaning I just wanted to find out who started the company, where they were operating in, what their financials looked like. But yeah, I'll be honest with you, my research on them has been really pretty shallow. Let's see what they look like today. Jumia Technologies, and this was that the company was actually based, if I remember correctly, the company is actually based out of Germany. It's promoted as this as being African and serving Africa, but I think it was actually based out of Germany. You see, In terms of recommendation trends, you have underperform and hold by almost everyone here. Morgan Stanley downgraded it to equal weight to underweight. Everyone else maintains. Well, that's actually Morgan Stanley the whole friggin' time. And Stiefel. Okay. So in terms of earnings, kind of all over the place, quarterly, all over the place, annually, it's still operating at a loss. Let me see here. Yeah, so honestly, I have to see more data. I need to do more research on this. I need to be able to determine where they're going in terms of their market, how they're investing, and that sort of thing. And I have not done that. So I'm not going to jump in and say that there's something right out of the gate here that bothers me about Jumia, because there isn't. But I'm also not going to be like enormously positive on what's going on. Oh, let's talk about nano dimensions. Let's talk about nano dimensions. So Nano Dimensions is a company that I did research on. I did a video on. It was actually when I was first getting started. This was one of my more popular videos outside of EVs, and I just sort of caught the sort of zeitgeist here of the time, where everything technology people were just going crazy over. So there isn't a reason to be invested in Nano Dimension at this time unless you view this as being just enormously speculative. A lot of the things that people claimed at the beginning of the nano dimension craze about their patents, about their technology, about their competitors, none of those are true anymore. They have, at least the last time I looked, and this was 7 or 8 months ago, they have at least 4 competitors. I will admit that their machine looks a lot cooler, but I don't know that that really matters in the long run, right? Yeah, so I think my thing is frozen here. But yes, so Nano Dimensions is not a company that I'd be holding long term. So I did research on bionanogenomics a couple of years or last year. Never ended up doing the video. The research that I did with the on bionano was completely contradicted by a scientist that I spoke with, who would not go on the record with me, by the way. I wanted to bring her on to talk about this. Her on. Yeah, I wanted to bring her on to talk about it. She wouldn't do it, but the research didn't jibe with what she was telling me that that BioNano could do, and how the technology that everyone thought was so special. She didn't think it was special at all, and even particularly useful, and that there were a number of products that would do kind of exactly the same thing with a little bit of tweaking and a lot less in the way of cost. So, yeah. Um, No, I have not. Not seriously, at least, Michael. But that is something that I'm probably looking to. If you notice, there was a change in um, Justice Department policy here when it comes to prosecuting people who commit computer crimes. It used to be that a lot of white hat hacking got prosecuted based on a law. I think it was made in like 1986 or 1987, the Computer Fraud and Misuse or an Abuse law. It's a really outdated law, but basically it got a lot of white hats hackers prosecuted as well. They just changed that recently, or in fact today, and it's based off a Supreme Court case where good actors who are breaking into computer systems to test their vulnerabilities and then kind of report them, the Department of Justice decided they're not going after these people anymore as long as they can prove that they're sort of like white hat hackers here. All right. Before that, people would not even go out and test vulnerabilities of a system because of the possibility of being prosecuted. So that's kind of changed. So in that respect, I've been looking a little bit harder. I mean, I haven't really delved into cybersecurity, but I have been thinking about it a little bit more and thinking that it may be time to carve out a certain percentage of my portfolio and dedicate that to cybersecurity. That's not something that I've done in the past. And I realize some people do that. That is not something that I've been in the past. So, oh, hold on a second. I got a question here. Protop Tom says, Protop Rom, man, I don't know what the problem is with my streaming software. software today, but it's really giving me trouble. So, Jason, I stay in the El Cajon area. Where's your restaurant? I'll visit you to support you, brother. So it's called Good Bar. It's in Point Loma. So it's at 1872 Rosecrans down in Point Loma. We have, it is a bar really with a kitchen, okay, and a small kitchen. And interestingly, before the pandemic, there was no kitchen there, and we had trouble making a profit, and we just barely broke even before everything went to hell. When the pandemic happened, the bar was shut down for 2 years, and we made a plan to come back with a vengeance. My business partner really did all the work on this, and we ended up buying a food truck, or really a trailer, to use as the kitchen for the bar, and it's worked out fantastically. We have a great menu there. It's very unique in terms of bar food. There's a specialty. I don't want to ruin it for you, but I will tell you that my business partner's from the East Coast, and we took an East Coast specialty there, and we're bringing it out here. And we have all local beers. The entire lineup is just local beer. And if you've been to San Diego, you know that our beer here is absolutely, first rate. And Jepson, I know you live in Belgium and you think your beer there is great. It is great. You got to come to San Diego just for the beer. George Chioto says, do you think that Google is a buy at this range? I absolutely think that Google is a buy at this range. So yeah, their advertising business has been upset as well by Apple's privacy policy. They're likely to have a privacy policy shift as well at some point, but they will find a new way to deliver targeted ads to their clients. This is what Google does. It's just going to take them a while to figure this out. Google also has a number of different lines of businesses that they are developing. So but yeah, so Google, I think, is a great thing. So, and what do you think about Walmart's cooperation with Symbotic? I have not looked into that yet, so I don't really have any intelligent thoughts on that. So, and Protop Ram, thank you so much. If you're going to visit next week with your friend, you can find my email address in the end of my videos. Let me know. I might be, so I have a little bit more free time, and I'm going to be in town at least for the next week or so. So I'd be happy to meet some of you guys down at the bar. And I'm not even sure the people working there know that I have a YouTube channel, by the way. My business is separate. So when I walk in there, I don't run day-to-day operations, but they all know who I am. So if we go there, I'll be sure to get you a drink. All right. Let me see here. Any other questions, folks? Let me see. All right. So I've been on for about an hour. I wanted to try and limit my live streams to about an hour instead of doing it for like an hour and a half, 2 hours. So yeah, why don't I go ahead and call this one a day? I'm going to try and come back tomorrow, do another one, but I'm going to make this almost a daily thing here. Like I said, Monday through Thursday at least. Really happy to do that. Yes, it is Protop Ram. It is 1872 Rosecrans. Anthony Walker says, okay, let's talk about that. You got back in the market today? Awesome. Amazon and PayPal. And by the way, Costco earnings are tomorrow. So I don't expect Costco earnings to be substantially different than Walmart and Target earnings. Let's talk about that for a second. Okay. Meaning that that consumer demand is going to be pretty strong. Spending is going to be pretty strong. Same store sales probably increase in the 3% range, but we're going to see earnings per share take a hit. You won't see as big a hit due to labor costs with Costco, because they already pay their employees really well. So I do know that they did raise wages a little bit, but you're going to see a lot less in terms of impact. But you're going to see more in terms of impact with supply chain issues with them too. So, and I would expect to see that their inventories are rather high as well. Anyway, so let's talk tomorrow, guys, when we'll talk about Costco earnings. All right. Thank you so much. I will see you folks next time.